The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Good morning, I'm Brian Akers from Akers Financial Group, and we welcome you to Winning in Retirement. I'm a certified financial planner practitioner, and so is my guest host today, Alex Monk. Good morning, Alex.
Brian, it's great to be here with you.
It's great having you here on the show. It's great to have a conversation today about investment secrets that people need to know. So are we supposed to whisper the secrets or yell it from a mountaintop? What do you think?
I mean, everyone needs to have someone look at what they're doing investment-wise and see if it's right.
Absolutely. So we don't tell me too many secrets right away. We want to ease into the secrets so that you understand that there's multiple secrets to investing for a lifetime. Winning in retirement is about investing in a way that's best for you and your individual, your unique portfolio. So Alex Monk has been with Akers Financial Group for 10 years. He is a certified financial planner practitioner, and he's one of the heads of our investment committee here at Akers Financial Group. Today's show, what we're doing is this. It's called Investment Secrets You Should Know. And the reason we want to have this show is because people are making a lot of mistakes right now in their investments because they're reacting instead of proactively investing their money in times like we're having. Volatility is where money can be made if you're making wise decisions within your plan. So understand what you need to do. So Alex, normally at Akers Financial Group, we always build core portfolio to start out with for our clients. Tell us a little bit about that.
All right, so the core part is exactly what it sounds like. It's our central allocation to general asset classes, meaning we want to have small caps, we want to have mid caps, we want to have large caps, we want to have a difference of value and growth, we want to have some international, we want to have some type of inflation hedge through commodities or precious metals. And then from there, we have to see what are we trying to accomplish with this money.
Yeah, absolutely. But the core, what you listed were all stocks.
Yeah.
So our core portfolio for the at-risk side is a diversified portfolio that generally is trying to take less risk than the market for our retirees.
Correct.
If someone's in different phases of life, we then we bump it up through different combinations of how we invest. And that's what the show's going to be about, is the investment secrets that you need to know about that you can add to have more income or to add more growth. Things that we need to think about and things that you ought to consider, especially when you're reviewing your portfolio at this time. Now, in our core portfolio, do we have bonds?
No, so we don't use bonds because we opt for fixed or fixed index or some type of insurance-based product that it's going to give us guaranteed income.
All right, so we're using something from an insurance company, a fixed index annuity, annuities that are providing guarantees, guaranteed based on what?
Based on the assets of the insurance company. So that's the first thing that we want to look at when we're saying, okay, is this company going to be here? And they have ratings through like S&P, Moody's, Fitch, the big rating agencies, and it's based on the assets they have on hand. Because I don't want to tell a client, Brian, hey, this is going to be our safe money, and then it's not safe.
Right. Well, it's not FDIC. Like at the banks, the FDIC is the federal government, the U.S. federal government backing your principal up to a limit of $250,000 per account per person. A lot more detail if you want to go to the FDIC site. You can figure out how the whole title 7 different ways to have the limits, which is pretty interesting. But when we're talking about the protected side, the reason we want to cover this is that if you don't have your core portfolio designed properly, you're probably in a panic mode when the market drops 10, 15, 18%. And then you react in the wrong way. If you've gone online and moved your S&P index fund to cash, you need to listen because I believe you've been doing yourself wrong.
Yeah. Well, and then let's say that you're using bonds for your safe money.
Sure.
And you've just checked and it's like, oh my gosh, my bond funds are even down 10%. That doesn't sound safe to me.
Right, absolutely. When you look at how do you lower risk, our concept for the last 20 some years is that if we want to lower risk, let's lower it to where it's protected, where we're not going to lose more money by dialing it back. And so the other thing is this, and that the environment we're in is an interest rate environment where they're starting to rise. When bonds see interest rates rising, the bond values go down.
They have to.
They have to. Why would you want a 1% bond? Now, if they're selling 3% bonds, who wants your 1% bond? You have to yard sale it. And that's called selling it at a discount.
Yep. So if you paid $100 for it, you may have to sell it for $97 or something to get the yield to whatever the market yield is.
Yeah, that yield maturity calculation cannot be done on the radio in a way anybody can understand. But the concept is this, is that if you own bond mutual funds, you have open-ended risk tied to interest rates. And that is not a way to reduce your risk in your portfolio. When you have a portfolio design as you're getting closer and closer to retirement, you want to dial back the risk to a point where you have some money that's safe. Now, the money that's in the market, you need it diversified and you need it to do well. Because guess what? Not everything's down 50% right now.
No. Energy's up.
Energy's up. Technology, a lot of technology is down 40, 50%, especially the ones that were up 100% are probably down 50% over the last 12 months. It's not just a most recent event. There's something called cryptocurrencies that are down a lot.
Oh, yeah.
They're down a lot, and people are questioning where's the next step for crypto. But our shows today is not about that, but it's about people that are taking risk off the table. So what's the fancy word for that?
De-risking?
Oh, yeah, that's it. You got it. De-risking their portfolio. That's what we've been seeing this year.
I know, and they think they're de-risking, Brian, but are they? I mean, I feel like they're locking in losses.
Yeah.
So
what's the difference there? Explain that for me.
Well, so de-risking would be, okay, I want to make an asset allocation change because my overall portfolio has way too much X, Y, or Z.
You're right. So you're talking about percentage-wise.
Right. So let's say you have 30% in growth stock and you need to be at 20. So
Mm-hmm.
then making that trade or those changes, that would be de-risking. If you're trying to panic and time the market or just get out of a volatile environment, that I think is even riskier.
Right, because what happens is fear, hope, and greed happens in your investment philosophy, which needs not to be included in the way you invest. So one of the investment secrets is this: take away fear, hope, and greed by having a plan. The fear in the market is when it starts to go down, you fear it's always going to go down. And so what happens is this: people sell as it's going down and they go to cash. They sell after they lost 5, 10, 15%, and they lock in a loss like Alex Monk just mentioned. And then what happens is this: that's fear. That fear is there. But when the market starts to come up, they start having this hope that it's going to go up and keep going up. The problem is if they're out of the market, when are they going to buy back in? And not until they see it positive again, because they want to see it moving up before they buy, which is the opposite of what we want to do. We want to buy like when blood's in the streets, when it's low, when everybody's saying run away. That's when you want to buy.
You can't do that if you're all in. So it's like we got to have that proper asset allocation.
Absolutely. To be able to reallocate into the market and to be able to allocate where the opportunities are. Because there are certain categories in a portfolio design that are down. They might be down 20% or more and be a great time to add a little bit more of that if you're buying high quality.
Absolutely. And there's other things in the market that aren't down, like high quality stuff.
Right. So this concept, fear, hope, and greed, that the finishing that up, greed is where when things are way up, you buy more because you think it's going to just keep going up forever. You might have said things such as, oh, I'm 40 years old, I'm going to retire next week because I made so much money where I put all my money in this one stock, and now all of a sudden I'm going to retire on that. When that comes out of your mouth, you ought to sell half or do something to diversify, because sort of you've cursed your portfolio. But the fear, hope, and greed, the greed makes you want to buy at the top. The fear makes you want to sell at the bottom. We want to do the opposite. When things are down, you want to look at your portfolio and is there some cash that you can buy? And that's generally you want to be buying, especially if you're accumulating. If you're in retirement, we do want to own stocks. We do want to hold the stocks. Now, what kind of stocks? It all depends on the purpose and what's going on in your investment life. Now, so core portfolio, Monk, is really our key topic here in the beginning is you must have a core portfolio to fall back on that's going to be there for your lifetime.
Right. And Ideally, in the perfect world, Brian, we would have enough on that safe side, that income side, to cover their needs. And that way we can take all that extra risk on the other side. So if you know that, you're not going to be missing paychecks, yada, 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 you can take risk with that money.
Absolutely. Taking the risk helps us beat inflation after tax over time. That's called a real rate of return. And you need money in the market to do those things. So that's money that's in the market, stays in the market. So it's very hard to guess the proper times to buy.
And I don't want to be the guy that's going to try to pick the top or the bottom. I mean, it's just, I hate being wrong, so I'm not going to do it.
Well, you're pretty much going to be wrong if you're guessing. Like if you said, well, today is the bottom or tomorrow is the top, you're going to be wrong. Depends all about the time. Well, it's the top for today. I can tell you what yesterday's top was. I can tell you that things are cheaper today than it was a few months ago. And I think that's how you make decisions when you're looking at people. But what I think you really got to do is look at the person first. You got to look at your plan. Yes, a financial plan. I know that doesn't sound fun. It doesn't sound like, I can double my money by planning. You can if you actually take the time to buy when everyone else doesn't want to buy.
But you got to have a plan in order to get rid of that emotion. So like if you're trying to time the market, when to get back in, instead of that, maybe go in over the next 6 months or the next year and set the time that you're going to do it and just do it.
Absolutely. Have a plan for your investments. So investment secrets that you should know. One of them is take the emotion out of your investing and really try to buy with a plan and purpose in mind. If you are going for a double or a triple and really trying to take a lot of risk, that should be only with the amount of money you can afford to completely lose.
Oh, wow. Don't say that to people. They'll get scared.
Well, but
it's the truth.
I mean, it's been fun when stocks rise up, but it never lasts forever.
Never.
The 90s, the bubble of the late 90s was an interesting time to be able to trade every day. But it was interesting because people thought back then it would just go up forever. The NASDAQ went down after 1999, went down and stayed down for almost 15 years before it came back to where it was. Right. So this show today is called Investment Secrets You Should Know. We want you to know this because the best part of your retirement is going to be getting your time back, where you decide how to use it. Before retirement, your time is tied up with other commitments, mainly your job. A lot of that goes away in retirement. Your time is now consumed by things you want to do. It's so easy to begin winning in retirement. Go to our website at akersfinancialgroup.com. Scroll to schedule a meeting section and let us know you'd like to schedule your free consultation with one of our team of advisors. That's akersfinancialgroup.com, or you can give us a call at 833-WIN-RETIRE. That's 833-WINRETIRE. We will call you on Monday to schedule your free in-person or Zoom meeting. Go to akersfinancialgroup.com or give us a call at 833-946-7384 to start planning for your retirement now. Do you really know why you're investing? We're going to talk about purpose in just 2 minutes when we come back for the second quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers, and here with me today is Alex Monk. We're both certified financial planner practitioners from Akers Financial Group, right here in Maryland, but we work with people all around the United States. All right, today we are having a show called Investment Secrets You Should Know. And the second quarter is about this. Do you really know why you're investing? And we're going to talk about purpose in just about 2 minutes. Oh, no. We're going to talk for 2 minutes. That's right. All right, Monk. So the idea of investing with purpose, what are your just quick thoughts on that?
How can you judge the results of something if you don't know what you're trying to accomplish? So that kind of gets me to the point of, if you don't know why you're investing the money, how are you going to judge the outcome?
If you don't have the end in sight, you're going to get in trouble, right? If you're sort of just rolling the dice and just let's take a flyer on that, that's not truly investing. That's more the gambling side.
Yeah, and that's just not the way to do it.
Right. So we've been talking about core investing in the first part, and then what we're going to do here in just a few seconds is we're going to run part of a show from a couple of weeks ago. Mark DiOrio, a chief investment officer at Brookstone Capital Management, came on our show just a couple of weeks ago, and we talked about satellite investing. That is where you have your core portfolio, and then you invest in other things, satellites that basically circle around or go around your core portfolio. And we found it very interesting for us to think about and to talk about these investment secrets that you need to know. So what I want you guys to do is just be ready for the Mark DiOrio section. I'm going to bring that up right now. So you have your core portfolio, and then you build satellite investments around that core portfolio. Yes, around. The satellite will move around. All right, so what kind of satellites would you recommend or want people to think about when it comes to adding on to core portfolios?
Yeah, and I just want to hit on how important this portfolio construction framework is. Having that core portfolio that we talked about in the third quarter allows you the flexibility in your portfolio to have a few satellites or opportunities that really make sense for maybe more defense, more income being generated off the portfolio for income ideas, or more growth-related activities. And it really helps you position size. That's a term I don't hear a lot of in the industry. I know we talk about it, Brian, about thoughtful portfolio construction. And if you have an idea, okay, well, you don't put everything in that idea. You put the appropriate size of the portfolio in there, and the satellite really gives you an idea of, okay, that's where it belongs. And so your core portfolio is participating in the markets and fully diversified, but here might be an opportunity that either the market presents or that you prefer. So if you want to invest in tech stocks, or a popular one is disruptive innovation stocks. And what is disruptive innovation? Well, it's looking at those companies that could be big and are really going to be impactful in 5 years. So that could be in genomics, for example, taking the handoff from pharmaceuticals. It could be in artificial intelligence type companies that really aren't mature yet. Revenue is just getting going, but they will have a big or an outsized impact in a number of years. And so you never know when that's going to be hot in the marketplace, but you know that it's coming. And you just want to have a position in there to participate. And if you put all your money in there, for example, and say, oh, it's the next thing, well, what happens is it's way too volatile to really be a comprehensive portfolio. But if you put a piece of your portfolio in there, it's more likely that you're going to be able to maintain that position and then participate in that wave.
Yeah, I was thinking about disruptive technology. Over the last 12 months, it's actually been one of those leading categories that have come down. And the reason it's come down is because of taking the profits of it being more rightly aligned with its earnings and price than it was just a year ago.
Yeah, correct. And it's very volatile. So when I look at areas and they're very volatile, I would say that's a satellite allocation, and you shouldn't be surprised by the volatility. It's that we know it is, and so you position size it, put it in the satellite. On the other side, you can look at some income opportunities that may make sense if you want more income being generated from your portfolio, but they may be a little bit different than the traditional stocks and bonds. Something that we've looked at is strategies that use covered call writing, and I don't want to get into the weeds with options, but this is a very straightforward strategy. It doesn't use leverage, or it's not exotic. It's basically you sell options to generate income on a standard portfolio or on a standard index that you'd invest in, and then you collect those premiums, it's called, and it generates income in the well above where bonds are at, for example. So that's a unique source of income. So what you're trying to do with those satellite allocations is find those unique opportunities. And I know I've looked at your portfolios, Brian, and really had a good first quarter of what you added into that satellite to complement that core portfolio. And I think it makes so much sense, especially how challenging markets are. And maybe you could, add a little bit on your thoughtful design of that portfolio.
Yeah, we put together a diversifier, which is a way to diversify from the core, sort of a defensive measure. And what we're trying to do there is we do have concerns about the U.S. currency over the long run. And so we have built a portfolio that we add in to the side of or on top of the core investments that we do. And that does have commodities and gold and different types of international and real estate inside of there, trying to create core assets that really hold value if there is a run on the dollar or any other issues that might occur. So that was just some ideas. And I know that you've been looking into lowering risk through the use of maybe buffer type investments.
Sure. This is a very new concept, very innovative, and kind of forward thinking. And so we are an early adopter of these ideas where, again, it's not an exotic strategy. It's just a sophisticated one. And again, doesn't necessarily use leverage or some of the things that are not traditional core strategies. It uses what are called buffers or options in the marketplace. Options have been around and used in different strategies, and there's different ways to use them. But here's very straightforward. What they're designed to do is you own an underlying equity stock basket, for example, so you have equity participation. But what they do, and we use a manager that does this, is they purchase protective options that really protect the downside. So it gives you kind of this downside buffer. So, for example, there's an ETF or a series of ETFs that launch every month. And what they do is say, okay, you own the S&P 500 for your equity basket. You have a 15% buffer on the downside over a 1-year outcome period. And so it buffers that first 15% of the downside, and that's really reduces risk. In fact, you see only as it's going throughout the year, you've only seen a lot less risk in those vehicles, a lot less volatility than you would if you're just generally outright owning stocks. Now, on the positive side, you get for that trade-off is, well, they cap the upside, and usually they cap the upside participation at 10%. So it's not a small number, and it'll vary every month. But I'm just giving broad terms, not a specific recommendation, but broad terms of how these work, which is, okay, you participate up to a certain cap. And so they all come out and they all post their buffers and caps every week. And so we monitor this, and it's very innovative. They have been growing, but we find them to be excellent vehicles in this marketplace because you can reduce your risk, again, without using bonds, which what we're concerned about, almost what you're talking about with your diversifier, which is what if traditional ideas are what if there's challenges that haven't been with us historically, for example, with the bond market with low interest rates. Well, what if instead of holding up when stocks go down, what if they go down when stocks go down? And so they defeat their diversification benefits. And so this is a way to add this or a way to have diversification or downside protection and not using bonds, or for that case, when bonds aren't providing that diversification benefit.
Yeah, so we strongly believe that the diversification is the key to investing and making your money last a lifetime. Now, what that means is based on your goals. Let's say your goal is you need more and more income. Our answer is take less risk to reach that income. How do you do that? How do you get the income and still take less risk? By having a core portfolio that is invested in stocks and then diversify more into the income side of our satellites. Now, let's say you're a few years away from retirement and you really want to grow. You want that money you don't want to catch up to a point where you're taking extraordinary risk, but you want to spice it up. Or let's say you're younger and you're just getting started. Absolutely, we need to be designing for growth and investing over time. And the satellite might be more of a part of the portfolio than typically recommended for someone as they get closer to retire. All of this comes together in a financial plan for our clients. All right, I'm back live now with you guys with Winning in Retirement. That was our information we had with Mark Diorio from a show a few weeks ago called Your Investment Portfolio. Today, we're talking about the core and the satellite even more in greater detail and given investment secrets that you should know. What is one of those key investment secrets there, Alex?
You got to figure out why you're investing. What's the end goal? What's the purpose? Because like Mark hinted at it, there's different types of satellites you can add. So you got to know what your goals are, what your purpose is.
When you know why you're investing your money, it makes it easier to handle the volatility that's going on. If you need money tomorrow, it should not be at risk. If you need money for the next 12 months, you should really have that in low risk investments. That's really the only way to build a retirement plan that's going to last a lifetime. Because what happens is this: we're fiduciaries. We only recommend things for you that we believe are to your advantage. That's how we run our business. We know the best way to grow our business is for you to have the best retirement possible. And that is truly a key on why you need to consider Akers Financial Group. We're local, we're independent, and we don't report to a big company on Wall Street. We report to you. We do have offices in Lutherville and Forest Hill and clients all around the country and even a few around the world. It's so easy to begin winning in retirement. You can give us a call for a free consultation with one of our team of advisors by calling 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll call you back on Monday to schedule your free in-person or Zoom meeting. Go ahead to AkersFinancialGroup.com or call 833-946-7384 to start planning for your retirement now. Will your retirement income pass the reliability test? We'll dive into that in the second half in just a couple minutes.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
I'm Brian Akers, and here with me today is Alex Monk. We're certified financial planner practitioners at Akers Financial Group. We want to welcome you to the second half of our show. Alex Monk, you're coming out of the halftime locker room, and you're doing all right?
I'm just getting warmed up. This is really where I thrive.
Well, I did put you on the bench in that second quarter because I had Mark Diorio. I brought some of his words back, and of course, it was him and I on the show there in the second quarter talking about satellite investing. Now, I want you to comment on the following. Will your retirement income pass the reliability test? And then we're going to try to dive into this idea here in the second half here. But really, in satellite investing that we're doing, what are ways that we help provide reliable income for clients?
So back to the core, the start, right, is going to be our portfolio. You're going to have stocks, then we're going to have some protected stuff for income. Now, in an ideal world, maybe that protected side could provide all that income, but that's not always the case, right? Because things cost more. So we need to build out satellites that produce dividends or, cash flow. And that's through either companies that are value-based, have strong earnings, good dividends, flight to quality, or there could be real estate. There can be commodities, oil and gas, all different types of sources. So if we have cash flow coming off of these investments, we don't necessarily have to worry about the risk of the price all day long.
Yeah, that's designing the income plan is very, very important. And then you have your core portfolio. That the goal there, if you can make 6 to 8% and live off of 4%, the math works out. But then the logistics of what do you actually buy to get that 6 to 8%, because on the fixed side, you're not getting 6 to 8%. So you got to make it up on the other side. So how you build that portfolio out is extremely important when it comes to designing for your retirement years. So let's say you're in your early 60s, getting ready to retire, and you're basically trying to dial back the risk and get ready to retire, but knowing that you must keep stocks into your retirement years. And the reason is that 12 years into retirement, you're going to look at your bills and say, well, they're a lot higher than when I first retired. I'm really glad I had some money grow outside of what I was taking out.
It's such a tough balance for people that are out there trying to do it on their own, because they're sitting at their computer, up all night. I've seen so many of these people just trying to figure it out on their own. Mm-hmm. And they've never done it before. It's like, are you willing to risk that much of your life, 30 years?
Well, there's a lot of information out there about just go buy an index fund and forget about it being the only answer. And the problem with that is it works fine till it doesn't.
Yeah,
and when it doesn't, there's this concept of big losses are hard to make up. If you're that person in the early 60s and you're looking at your investment portfolio and going, wow, a 20% hit, that's going to take a while to get back up. It might take a year to a year and a half to get back to where you were. And can you imagine if you had to sell some stocks at that time?
Well, and that's the big flaw is if your income's not set up right and you're selling out of the market monthly, you can really do some damage during a volatile time. Because you know what's not a secret? The stock market goes down sometimes.
On average, it goes down 14.7% at least once every year. Not every 10 years. Every year it has that kind of volatility.
And every time it happens, it's like, what's happening?
Right. And there's a panic and people sell out and they try to guess. And usually they're selling after it's already down. So investment secrets that we should know is this. We have the purpose and the why. We build our core portfolio. We need to add some satellites for income. What are some ideas for income that's not on the fixed index annuity or income riders or guaranteeing income from that? But where do we get income from?
You can buy funds that do like covered calls, which is using options. So stock options where you sell two of them. So you're not open. Like a naked option is where you don't own the underlying stock. So that's very risky to do. But in a covered call, you either own the stock and you sell calls against it for income, or you do spreads where you sell a call and buy a put or vice versa.
And we have income managers that do this kind of thing for our clients to basically protect the downside while you're getting the dividends and even making money by selling some of these calls as a way of producing income.
Yeah, and there's other structured products that are based on a stock or an index that may pay a coupon, but they have some risk associated with them. But that's another alternative way to generate.
One of the things that works in a high inflation environment is simple dividend stocks. Dividend stocks have been holding value because they are typically non-cyclical, meaning that people keep buying their products. They keep pushing out dividends and revenue to the shareholder, and that's us, the investor. We want to get dividends. We need that dividend to live off of. So one of the things about retirement that we like to do is to turn all the income on. Like sometimes we're owning stocks and we're reinvesting the dividend in our retirement years. So we're reinvesting the dividend and we're paying tax on it. And then we're drawing money from somewhere else that's taxable to make our income meet. And so one of the things we do when we do our first initial review for a client is we turn things on. And we get the money and the flow, the cash flow going. Because one of the things that happens is that during our lifetime, many of us accumulate different types of investments. And we need to know what we own, how to use them, and does it fit in your retirement years? And then what you do is build your portfolio, your income portfolio all around that.
Yeah, and if you have like an old account or something, variable annuity someone sold you years ago, you don't really know what it does, call someone, call us and ask. Because a lot of those policies, Brian, could be great or they could be terrible.
But you have to use them properly. Or there's like the index annuities somebody might have bought, say 10 years ago, that might have had different stories to them that you might say, well, did it work out or not? The hard part is what I'm doing is I'm thinking about this one client who came in. She was a listener for a long time, and she's had investments like 10 years with other advisors. And so what I did is I tried to explain what she owned and how it works. And then what I really got into is when to turn the income on because I felt that it had a piece that we could use for her guaranteed income for life. So I thought that was important to know, is that knowing where you are to start is key to any kind of financial plan. It also helps us with building a retirement income that becomes reliable, that you know that check's going to be in that bank account each and every month.
Yeah, and that way, when we sit down with these clients getting ready to retire, we can show them what this guaranteed income will be. Like, that's a big deal.
Well, what you want to be able to do is to be able to sleep better at night, even if you watch the news and you see the market down, that you know that your money's taken care of and that things are okay. Extremely important to lower that stress level by how you design your portfolio. And investment secrets, when it comes down to a rising interest rates environment, is to ladder things that you buy. If you see a CD rate comes out and all of a sudden it's at 2-3%, if you get too excited and put all your money into it, that's not the best thing in a rising interest rate environment. We got to use just a simple concept of laddering into a rising environment like this. Laddering is maybe buy a 1 year, 2, 3, 4, 5 year. You ladder it out. You don't want to buy all 5 years out there and lock in a rate that might get a lot better very soon.
That's like it's kind of like diversifying based on length.
By investing in time horizon, because there's really only two ways to make money on your money. It's take more risk or give it more time. For a few years now, interest was not giving us more money or more rate of return for locking in more time. But that's starting to happen. It hasn't really happened on the 10-year treasury yet, but it's starting to happen where length of time will give you some more income. So that's one of the ideas for retirement income, that we're going to have some money available to buy into that as rates do rise over the next year to 5 years.
Yeah, and having that balance really, really helps during volatile times, because you need your income. There's not going to be a month where you're like, you know what, I'm going to take this month off, don't pay me. No big deal.
Yeah. There's so many things about planning that comes across my mind. I don't know where to start, but when it comes to just simply this, you want retirement income that's reliable, you need to build a reliable portfolio to give it. If you want to take a lot of high risk, that's not going to provide you reliable income. It just doesn't work that way. You got to build a portfolio designed with the purpose in mind and the risk and the goal in mind.
Right. And then that could be so many different things for so many different people. So the biggest secret there is know what you want out of what your goal is, the end goal. That's how we're going to be able to design a portfolio. Okay, I want to do this much money a month, or I want to leave X number of dollars to my kids, or
right.
I want to buy a beach house, or I want a boat. Like, all those things are important. And then we got to make the money do that. It's just a tool to get what we want out of life.
The more time you have to plan, you can really win in retirement because you have the time to build it. Winning in retirement, if I had to draw the perfect retirement plan, that would be, hey, I want some tax-free income. I like most of it to be tax-free. And so guess what? You can do that, but you have to start young, start early, start often, and build portfolios designed with that in mind. So you can have tax-free income that you can turn on when it's time for you to retire.
And taxes are such a huge deal. And we always meet with clients to make sure we're maxing out tax brackets at the end of the year. So if you didn't put the work in, there's still hope. We can tax plan, we can get as much money out as possible under these current rates, which are good tax rates.
Yeah, the current tax rates are in effect for 4 more years until the beginning of 2026, unless the law changes, of course. But right now, we have 4 years till the tax rate goes up, and we have an opportunity to take advantage of that. Now, we also have opportunities in investment fields when markets drop down. One way of looking at it is this. If you're retired and all your money's in stocks, you should be panicking a little bit when a market drops 15 to 20%, because that's all of your money. You put it all in stocks, which you shouldn't be doing. If you're younger and you see the market go down, your mindset should be, wow, I can buy at a discount. I can buy low. And the idea is this. We need to invest in things for the long term. That long term could be 3, 5, 10 years down the road. The longer you have, the better to be able to take risk in high quality investments. There's some really good investments that are on sale.
Absolutely. But it's such a mental game, and people don't want to buy stuff at a discount in the stock market. But
no, it's like, hey, I'm going to go shopping, and when anything it says is up 30%, I'm going to buy. No, but investments, that's what people like to do. Oh, it doubled last year. Oh, give me some of that. No, it's the opposite when it comes to your investment. The investment secret here is this: buy low. It's not a big secret until you actually do it. To actually buy low is something that you need to do. And the reason you want to do this is you want to have a plan so that in retirement, the biggest worry of your day will be where you're going to drink your morning cup of coffee, where every day in retirement seems like a Saturday free of stress, where your retirement income is reliable and planned out and taken care of by the team of advisors at Akers Financial Group. It's so easy to begin winning in retirement with one of their team of advisors. For that free meeting, it's all about you and about your retirement. You just give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We will call you on Monday to schedule a free in-person or Zoom meeting. Go to AkersFinancialGroup.com or give us a call at 833-946-7384 to start planning for your retirement now. Market timing is an oxymoron. We'll explain in 2 minutes in the fourth quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers. Here with me today is Alex Monk. We're both certified financial planner practitioners from Akers Financial Group, located in Lutherville and Forest Hill, Maryland. But we do work with clients all around the country and all around the world. We do have clients in different places. It's pretty interesting. All right, Alex, so we're here in the fourth quarter. We talked about a lot of things so far. If you missed anything, you can go to our website at akersfinancialgroup.com. On that website, go ahead and click radio, and you can hear the radio show again. It'll be up online. I'll come up here real soon. You also can hear any past show right through our website, akersfinancialgroup.com. So don't feel shy to go listen to it over and over again so you can understand what we're trying to say. But more importantly, go ahead and give us a call. Sit down and talk about your unique financial situation. All right, Alex, you ready to go here in the fourth quarter?
Let's do this thing.
All right, so the comment I had ending the third was market timing is an oxymoron. We'll explain in the fourth quarter. Market timing is oxymoron. What's meant by that?
Oh, it means if you're going to try to time the market, you're a moron. No, I'm just kidding.
No, we shouldn't be saying that. Be nice to everyone. Because there are some people who watch it every day, and that's probably one of the habits that's a bad thing to have, is a habit of watching every day, and then they get out once they start seeing some losses.
And is that what you really want to do every day when you're retired?
Yeah, well, I'm thinking about 3 new people I've met with recently that they sold out, and they think they got out at a good time, of course, but all 3 got out after losing.
The problem is, how do you get back in? It's just, you have to make 2 perfect decisions. And that is, it's very tough.
Yeah. The hard part, you're right. 2 perfect decisions. You got to buy when it's proper, and you got to be able to buy lower than you got out so you make some money. Most people don't. They get out, and then they don't feel good again until it's above where they were, and then they missed out.
Right. And that's just the fear, right? So the fear is because there's no plan. Mm-hmm. You got to know where you're going, and they're just winging it.
Well, the sad part is what we've seen in our career are people who get out and don't go back in. And those are people that regret it greatly after the market does fully recover. Typically, recoveries can happen over time, but usually they happen over short periods of time. They might be a year from now. All of a sudden, the market will bump up 4,000 or 5,000 points on the Dow.
It's usually quickly. 5 or 10 days in the year are the best days.
Yeah, and you got to guess when they are. And I've never been able to guess. The key to investments is this. So the investment secret you should know is this: invest your money that's for long term and put it in high quality stocks. You should diversify it so that you can be in stocks that are going to do well over time. In our style of core and satellite, on our satellite piece, there are certain satellites that we're buying into right now. What kind of satellites are we buying into there?
I like it. It depends on the allocation of the person, right, Brian? But tech right now has been beat up pretty bad.
Absolutely. So buying into tech and looking at those opportunities and adding a little bit in there can help your portfolio catch back up.
Yeah. And that being said, you got to make sure you're not already overweight tech, because a lot of people got real excited about that market run up. It was exciting.
Yeah,
it was. But now we're going through, you said this the other day, this is a normal business cycle. Mm-hmm. This happens.
Well, inflation comes, interest rates start to rise. We haven't seen it probably in over 20-some years, a true interest rate rising, and it's going to keep going for a while here. And inflation, that's real. People are actually seeing it everywhere they go, inflation.
Everywhere. And wages aren't growing that fast either. So it's this is not an unprecedented time. These things happen.
But there's ways of managing through this. Some of it is core financial planning. Core financial planning to me is get your fundamentals right. Get yourself out of debt. Make sure you have a strong cash flow heading into retirement. Build tax-free income. Build your income. Know where it's going to come from. Know that it's reliable and sustainable, and it's going to keep up with inflation because of the way you designed it. Right. That's winning in retirement. To win in retirement, you got to start as soon as you start working, saving money, so that money's there for you when you're ready to turn on for those retirement years.
And then, those high quality stocks, they usually pay dividends. So if things are down, you may not have to sell anything to get your income. You can just turn your dividends on, like you said earlier today.
Absolutely. So let's just say I had a client coming in and they're retiring right now. I look at the market's down, and I would say, well, look at our allocation. Is our allocation correct? What kind of changes we need to make? What can we buy to add value? So in the satellite concepts, what is down that can add value? What does the client need? What is their why, their purpose? Knowing that helps us decide what to buy. It's very important to sit down and talk about this. Don't just follow someone and say, oh, buy the stock. It's a good buy right now. Buy a portfolio that fits every need in your financial plan. Very, very important.
Yeah, and I met with a client last week, and I said, I think we really need to add some value stocks. And he said, well, they're not down as much as all my growth stocks. And then I showed him his overall allocation, and he was already way overweight in growth stocks. Yeah. We were just going to use some of the cash to balance it out. That you need to know where it is so you can make those decisions.
All right, so we do get people that call the radio show. They come in and meet with us, and we get these portfolios from where their money is now. And we are sort of surprised by what we see when people come in, because sometimes it's a collection of things. Other times it's something where this person's been very active their whole life. They build a lot of portfolio out. Some are very detailed investors, some are not. They come in all different sizes when it comes to the portfolio design. But many times how they draw income is a big problem. Mm-hmm. What I mean by that is we've seen portfolios at a stockbroker's firm where they're selling stocks every month to give you your monthly check.
And he's probably getting paid on all the funds before they're sold. So the more they keep invested, the better for them.
Yes, because if you put money in cash, the fee is not applied to the cash portion. And so why keep money in cash? You don't get fee on that, right?
Well, it's the right thing to do for the client.
Well, we believe when the market gets up, you take winnings off the table, you build your annual cash up, you try to line up where that income is going to come just in case the market would drop. So that when the market drops, you're not like, oh, well, I got to sell while it's low and lock in a loss and then basically make two losses because you lock it in, you can't recover because you just needed the money.
Yeah, and then it gives you the ability to pull from some of your safer investments and add them if that makes sense overall for your allocation. Or what I love to do is talk about Roth conversions when the market's down.
It's a perfect time to do Roth conversions when things are down, and you can take a fund that's down, maybe more than the market, and you can convert it, pay tax now, and then pay tax never again by moving it to a Roth IRA. That's an excellent planning tool to do. Today's show is called Investment Secrets You Should Know. We've been covering ideas of what's your purpose, the fear, hope, and greed, take the emotions out of what's going on. Some of the secrets of having covered call investing for income. That was just one we just covered very slightly. We've talked about dividend stocks and why they're so important in maintaining stability and income. How reinvesting dividends during retirement is not the best thing. You might need to start using that money for income. It should be one of your first sources for income. It's just turn the dividends on and put it in your pocket. Investing money right now, buying things that are down and building your portfolio out, such as technology type stocks, looking at your allocation, reallocating. We're just hitting up some ideas. All right, there's only a few minutes left in the show. What did we miss?
Real estate.
Real estate, absolutely. What about real estate?
So like a hard asset is going to be a great thing to own in an inflationary environment, right? It's real. You can touch it. The volatility isn't quite the same as the stock market. Now, don't get me wrong. The real estate market has risk in it as well, but it's not 100% correlated to the stock market. And it produces income.
Right. So real estate, when we're talking about real estate investing, we're talking about income producing investments. We're not really talking about residential houses. Residential houses are interest rate sensitive, where they will probably come down in value as interest rates continue to rise, where the people looking to buy your home will not be able to afford a higher price when the mortgage payment keeps rising with the interest rates.
And they're going up fast.
Yeah, they are. They didn't go down quite as fast as they've gone up, but it's pretty crazy. And the other thing I've seen is that the bank interest rates on the money in the bank has not gone up as fast as the mortgage rates.
Not nearly. Not even close.
So what you got to do is you got to shop your financial products, your tools, everything that's going on. You need to shop and work through them to make sure they apply properly to your financial life. Financial planning is where we always start. To have a fiduciary relationship with someone, you must have a financial advisor that's going to ask you a lot of questions about where you are now. Investment secrets and how to invest money is a byproduct of that plan. Make sure you know where your money is now and then build a plan and invest accordingly. That's exactly what we try to do at Akers Financial Group.
Yeah, and I tell people when they first meet, they're like, all right, well, what investment should I do? I go, I have no clue. Like, I just met you.
I always reach behind me and say, "Oh, I got that right here." I'd like a make-believe shelf. Like I have the perfect investment already.
I said, no, I got to figure out who you are, what do you have available? Because, you might have some stuff that you can't get anywhere else. So you got to figure it all out.
If you're sitting in front of a financial person and they have a business card, what you need to do is look at it and see if it has two sides to the card or if it's one-sided. So you can find out where they're coming from when it comes to their business design. Are they an insurance-only person? Usually they'll have a one-sided card because they don't have all the disclosures a stockbroker or a registered investment advisor representative would have to have. That's why our cards are full two-sided because of so many licenses and all the different type of investments we can do for clients.
Well, we want to be able to help them with whatever they come through the door with.
That was exactly the design of Akers Financial Group. It's planning for the client. The client we come down to an answer that we need to provide, and then we have that product available through all the possible solutions that are out there. We have different ways of providing the answer, and we can go get that. We're not stuck with, here's the product. Now you're taking that product. It's not the way to design your portfolio.
Not the way it works.
Right. So here on Winning in Retirement, we want you to win in retirement. You got to prepare to win in retirement. So the younger you are, the sooner you got to get started and get going. If you're close to retirement, there's some cleaning up to do and getting things ready to retire in a volatile time. All very important. But today's show, investment secrets you should know. Hopefully you were paying attention to some of these. These are not all the secrets we got. We saved a few for the in-person meeting. Thanks, Alex, for a good show.
It was fun.
I appreciate that. And we want you all to be winning in retirement. So take advantage of the opportunity to start working with us at Akers Financial Group. To schedule that free meeting with one of our team of advisors, go to our website at akersfinancialgroup.com. Scroll to schedule a meeting section and let us know you'd like to schedule your free meeting. That's akersfinancialgroup.com, or you can give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll call you back on Monday to schedule your free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to akersfinancialgroup.com or give us a call at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Brian Akers of Akers Financial Group is a registered representative offering securities through Kalos Capital Incorporated and investment advisory services through Kalos Management Incorporated. Akers Financial Group is not an affiliate or subsidiary of Kalos Capital or Kalos Management and does not provide tax and legal services. Advice given on Winning in Retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment.